What is risk? And when we are saying what is risk, we're talking specifically about risk in investing, because so many people don't seem to understand the risk and how risk works when it comes to investing. So number one, the biggest risk in terms of investing is not doing anything. If you do not start saving money, irrespective of where it is, I don't care if you put money into your little piggy bank that's at home. If you don't start doing that, you're never going to build up an emergency fund. You're never going to build up retirement funding. You're never going to build up money to make you wealthy into the future. You're never going to have peace of mind that you've got enough. So doing nothing, that is the biggest risk. So let's have a look at a spectrum of risk. And in the spectrum of risk, when we talk about it, it's basically a straight line from point 1 to point 10, for argument's sake, where on point 1 is the safest and the most guaranteed investments that you can have, and point number 10 is the most risky investments that you can have. Now, when it comes to risk, if you invest into a very safe investment, then you know normally that your capital is protected, and you know that the growth that you're going to get is specified at a certain growth rate. And that is normally pretty low because you are buying into a guarantee. But if you go onto the far right side, into the very extreme side, then you are looking at investments that are very risky, but potentially has very, very big returns. But it is risky in the sense that those type of investments can fall apart, completely go under and lose all your money. So, on a risk spectrum, let me give you my opinion on what risk is in terms of this line. First of all is guarantees. You can buy a guarantee in terms of government bonds. You can buy a guarantee in terms of an investment bank where it's a 32-day or 3 months investment where you get a guarantee of say 7 or 8 or 9% interest. That is most probably the best guarantees that you can have. In terms of income plans, you can go and buy an income plan where your income is guaranteed for a period, it be that 5 years, 10 years, 15 years, or the rest of your life. These are guarantees. These are the safest possible investments. Then you move on to investments with a low risk. Now, investments with a low risk is government bonds, bank savings. Again, when you're talking about bank savings account that is not fixed on a investment percentage, income portfolios and stable funds. These are different portfolios that can be used, and their risk is a little bit higher than your guarantees, not very much, and the potential return there is only slightly better than what you would get in a guarantee. Then we go to medium risk funds. So when we start moving into medium risk funds, this is where you start making use of more shares in a portfolio or an investment. So in this portfolio that you choose, there will be some shares, there will still be some money, meaning cash, there will still be some bonds and properties. So there will be a combination of all of these, but the adding of some shares now makes it a medium risk funds because those shares are more volatile and can move up and down. It is not as stable as the cash and the bonds that you have in the investment. Then we go over to medium high. So when we talk about medium high, we are talking about things such as equity portfolios or global equity portfolios. This is where your investment portfolio is made up primarily of shares. So you're looking at a portfolio that's made up of 90, 95, 100% in shares. And if it's a general equity, it's most probably local shares or a combination of local international shares. And when it's a global portfolio, then it is international shares. Now, this is seen as medium high or higher because it's a combination of shares. But it's not really that high and risky, because if you've got 20 or 50 shares in your portfolios, that means you've bought into 20 or 50 companies, that you bought these stocks on the Joburg Stock Exchange, on the Dow Jones, whatever the case might be. And that portfolio manager, he has to investigate all those companies and make sure that he's buying the best shares for you. So it is not definite that this is high risk. Now, high risk, I would try to explain to you, is the volatility. Because if the markets do take a bit of a downturn and takes a week or a month or 3 months or a year to recover, in that period, the investment of the investor has reduced in value. So your investment might have been 1 million rand worth, and then there's a downturn in the market, and because of that, your investment is now only 900,000, and it takes a year for the market to recover before you get back to your billion rand. That is what people see as the risk. I have lost money because my investment has reduced in value. You have not lost money until you actually sell the investment, until you actually withdraw from that investment. So as long as you stay in that investment, you wait for the recovery, then at the end of the recovery period, then you withdraw your money, you have not lost anything. But that is perceived to be a medium-high risk because there is the potential of these fluctuations. Then we look at high risk. Now, high risk is where you are not invested in a portfolio, which is made up by a portfolio manager on your behalf, but where you buy into shares, where you buy into share trading, where you do Forex, where you do property investments. That is where you, as the individual, decide to go out and buy shares direct, to go and do share trading on some other platform. And there's plenty of these platforms where you start doing Forex trading, or where you go to a company that does Forex trading for you. This is the higher risk because if you are buying and selling shares yourself, you are responsible to do that research to go and find out if it's a good company, where in a share portfolio, the stockbroker or the portfolio manager would be doing all of that on your behalf. When you take that responsibility, and especially if you don't have knowledge about it, it becomes a higher risk. The same with Forex. You would have seen so many marketing and social media and all kinds of things out there about people talking about Forex trading and bots and all of that kind of thing. That all has to do with Forex. Once again, it is higher risk because you are either dependent on a market that somebody promises to be a guru in, or you yourself are investing in that market. So now we've covered guaranteed, low, medium, medium high, and high. Then we go into higher risk. So what is higher risk? Higher risk is when we are talking about alternative investments or arbitrage. And yes, I know not everybody is going to agree with me, but this is my opinion. When you look at alternative investments, alternative companies is similar to a portfolio that you can get through an investment house. But the difference now is that alternative investment that company provides does not buy into companies that's listed on the Johannesburg Stock Exchange or on the Dow Jones. They are buying into private companies. Now, when a company is listed on the JSE or on the Dow Jones, they have to go through a rigorous process in order to be listed. Okay? When it's a private company, you don't have to go through that. So when these companies, when alternative companies invest in alternative investments for you, they buy into private companies. And because they buy into these private companies, they don't have to tell you which companies they are bought into. They don't have to necessarily show you the financial statements of these companies. They don't have to show you how they have actually made these good growth. So what's the risk with regards to that? Number one, it's private companies that they are buying into. And number two, we don't know how the finances are being managed behind the scene. Now, I know people are going to say, you don't know what you're talking about, but that's the way I see it. And in terms of arbitrage, yes, it's a guaranteed buy and a guaranteed sell of a cryptocurrency, and the profit is already built in. But here I am making use of a company. And I have to trust that company and their management that they will be doing the best they can with my money and not mismanaging their company. I have to trust that there's not going to be fraud, there's not going to be corruption. I have to trust that the company is going to be financially well, who is doing the arbitrage on my behalf. So you're buying into one specific company, believing one company to do the best for you. And that's where the risk comes in with regards to arbitrage. It's not a combination of arbitrage companies that makes up a portfolio that you can go into and say, well, there's 20 arbitrage companies. If one of them fails, at least the other 19 is going on. You bought into one company, so it makes the risk higher. Then we go on to very high risk. And very high risk is your own business. Now, I know that plenty of people want to go into their own business, but the problem is Not the problem with people who want to start their own businesses. Absolutely not. I encourage people to start their own businesses. The problem is people that start their own businesses normally don't do proper research. They don't do due diligence. They don't figure out how to run a business. They don't learn upfront how to do business and how to run a business and what they should be doing and what they should not be doing. And very often people say, well, I'm going to start this business. I am going to sell big pens, and it's so easy because I buy 1,000 big pens at R1 a pen. I sell those big pens at R2 a pen. I make a quick 100% profit and it's over and done with. And then when they get into the business, they come to realize, but I don't have enough clients, I don't have enough storage space, I don't have enough courier services, I have to pay for this, I have to pay for an admin person, I have to pay for the technology, I have to pay for the accounting. So learn how to do a business before you go into business. And the reason why I say it's very high risk is statistics already proves it. Statistics says that 2 out of every 10 businesses that started survives. And out of those 2 businesses that actually survive, one becomes successful. The other one is basically just like a place of employment for the owner that does not become successful. So it is very high risk. Now, if you've got capital that you want to invest, especially if you are risk averse, you don't want to take risk, then you have to seriously consider what you want to do and gonna do if it comes to a new business. Very often people say, no, I'm going to start a new business, it's going to work and it's not risky. It is one of the most risky things that you can do. And then we get to the last one, and that is extreme risk. Now, what is extreme risk? Well, extreme risk is pyramid schemes, Ponzi schemes, gambling, and criminal activity. And I know you are going to look at me funny now and say, but that's not investments. Yes, I know it's not investments. Criminal activity is not investment. Gambling is not an investment. Ponzi schemes and pyramid schemes are definitely not investments. The problem is with these things is that people don't see it for what it is until it's too late. And what happens with Ponzi and pyramid schemes is that people come out and they show you this investment, how great it is. And the first people that get into it normally make good money. And normally they make good money over and over and over. Up to a certain point. When that Ponzi or pyramid scheme can't sustain itself anymore and it then collapses, it takes a lot of people with them. The people that got in the beginning, they don't really mind so much because they've made their money 3, 4, 5 times over. But the last people that got in, and that's the majority of people, they are very upset because they've lost everything. Now, this is the thing. With pyramid and Ponzi schemes, it looks like a very viable investment. It looks like you can't lose. And it always looks better than what it is. You cannot expect to get the type of returns on a normal investment that people offer you on Ponzi and pyramid schemes. But that is the extreme risk. The first people into schemes like that, they do actually make money. The people that come later, they just lose their money. And yes, I know, like I say, it's not an investment, but people see it as an investment because they don't realize that they're getting into a pyramid scheme or Ponzi scheme. So folks, I hope that this little explanation of risk gives you a better understanding of what risk means when it comes to investment. And I hope that it will guide you into the future when you have to make your own investment decisions in terms of your personal investments. Keep well. Bye-bye.